these examples show that a real estate company is essentially two companies. So one which is owning the inventory and which is earning a return on capital on that inventory based on the appreciation in that inventory. And the second part is the actual manufacturing or the home building or designing process. Hi, good evening everyone. The dates for the next 3 FOFs are on the slide, so please make a note of the same. So I'll be talking about the US home builders industry, uh, analogous to, let's say, the Indian real estate developers, but from US company specific. Now, before I start the presentation, just a disclaimer that I'll be talking about a lot of companies, some in detail, some not so much in detail. But this is not a buy, sell, hold kind of a recommendation on any of them. This is just an attempt to understand the industry, how that industry has evolved, and can there be some lessons from the same for us. So before I actually go into the evolution of this industry over the past decade, I just wanted to give you some context of the US home building industry because it is a bit different from the way home building happens in India. So in India, most of the real estate developers that you would be familiar with make multi-storied apartments. A typical apartment will have 12, 15, 20 stories, multiple houses. In US, on the other hand, most of the housing tends to be what is called single family housing. So you would have seen this in Hollywood movies or TV series. These are individual sort of bungalows wherein a single family stays. So almost 70% of the housing in US is single family housing, and most of the developers concentrate on this segment. So multifamily is also one of the things that they do, but bulk of the business tends to be centered around single family housing. Again, over the course of this presentation, you will hear me talk a lot about land lots. So what happens is a developer would buy or somebody would buy a large plot of land, and that plot will then be subdivided into lots. So one lot will have one individual single family house. So when I talk in terms of lots, that is the land for one single family housing unit. Again, these are some of the companies that you will hear about in the presentation going forward. So, DR Horton is the largest home builder. There is Lennar, there is Pulte Group, NVR, Meritage, KB Homes, Taylor Morrison. Ignore the numbers for now. This is just so that, when you hear these names, you get an idea that these are home builders. So, to understand the evolution of this industry over the past decade, we need to understand what the US home builders went through during the last cycle. During that period from 2000 to 2008, that boom and bust and the consequent experience of US home builders is what made them change their business models. So, this is something that is well known. You saw a massive subprime mortgage led housing boom in the US from 95 to 2005. The number of houses sold almost doubled over this period. Again, this is not a emerging market country which is growing at 7-8% in terms of real GDP. This is a country, developed market country, wherein the real GDP is, let's say, 3-4%. So when housing doubles, that is quite a bit of a boom from that country's perspective. Along with that, the prices of the houses went up, and most importantly, they went up almost very linearly over the decade. So every year you would see some or the other price increase. So Citigroup CEO made this famous statement that as long as the music is playing, you've got to get up and dance. So that is what the home builders did. They got up and danced. They grew very aggressively. And when you want to grow, they bought up a lot of land, they built up a lot of inventory. In that period of growth, to fund that growth, a lot of that growth came in via debt. So this is the period wherein you saw massive growth in revenues, profitability, and debt for these companies. But then the music shop stopped in 2008, and you saw a string of bankruptcies. Many major home builders went bankrupt. Even many of the big, large surviving ones went through periods wherein a lot of the balance sheet strength completely evaporated. So, equity came almost to a negligible point because of the write downs and everything that they had to take. So far, this is something that most of us know, or most of us would have expected that this is how the cycle would have played out for a real estate company in a real estate boom. But the interesting thing in this was that not everybody had a terrible time. If you look at the larger home builders, there was one home builder that actually did not have that much of a trouble. So if you look at this shows the return on tangible equity over this 3-year period wherein these companies were going through a bust. Almost all and this is the ones that are surviving today. So many of them just went out of business. And if you see, most of them saw huge write-downs, equity got evaporated. But even in this very bad period, one company, which is NVR, had a 10% return on equity. Now, 10% might not sound that great, but remember, this is the worst residential or worst real estate crisis for that country in almost 40-50 years. So during that period, if that company is profitable, then something interesting must be happening. Again, the markets took notice. So if you look at the valuations that many of these companies were trading at, 2-3 years later, most of the home builders were trading at 1.3 times, 1.5 times kind of price to book, while NVR quoted at almost double that valuation. So markets definitely gave it a premium for whatever they were doing. So what did NVR do that made it profitable even during a bad time? We'll come to that, but before that, let's just take a step back and try and understand what happens in a traditional, when you do real estate in a traditional way, what are the challenges, and probably then we'll be better able to appreciate what NVR did. So the first thing is that land development is a very time consuming and expensive process. Now, land development means you take a raw parcel of land and you take it to the stage wherein the construction can then actually start to happen. So typically, land will form about 20 to 30% of the cost of the house. Now, this is from Amadu? Yeah. This is from a regulatory filing. So in US, there are companies that exclusively focus on land development. So all they'll do is they'll take that raw land, get it to a stage wherein a developer can acquire that land and then sell it off at that stage. So this is one of those companies. And if you look at their regulatory filings, what they say is Millrose tends to focus on short duration land transactions, typically 5 years or less. So a 5-year period is actually short according to them for this process. So the process typically starts with the land developer identifies a plot of land and you sign a letter of intent with that seller. Then there will be a period of due diligence wherein their legal teams, compliance teams will see whether the entitlement is clear, whether there are any earlier issues with the land or not, whether there can be any environmental issues or so on. This period can take anywhere from 6 months to a year. If the due diligence clears, that is when they will actually go ahead and buy that parcel of land. Now, typically this is 30% of the cost of the land. So 70% is what comes after this. A lot of time gets spent in zoning and permitting. So, like in many countries, US also has very strict zoning regulations. Zoning essentially means the relevant authority decides what a particular plot of land can be used for. So if a plot is meant for agricultural use, it will be used for agriculture. It can be, uh, in fact, even single family and multifamily have separate zonings. So you cannot create a multifamily apartment on a single family zoned land. Now, if you bought a land which is meant for, let's say, an industrial use or an agricultural use, you need to get it rezoned. That rezoning will need approvals at the levels of county, state. Post that, you will need approvals for, sorry, post that, you will need approvals for environmental clearances. You might need to satisfy the local county that whatever you are doing is not harming the environment and so on. And after that, you need to construct the utilities and infrastructures around that land. So this typically involves doing the landscaping of that land, making provisions for drainage, sewage, putting in lines for water, putting in lines, putting in roadways, sidewalks, all of that. This process is called horizontal development. And this is almost 70% of the cost of the land. So this process put together can take anywhere between 5 years or even more than that. So in order to save time, there's actually a really good video on YouTube which does a time lapse of this entire 3 to 5 year period, but it's a 12-minute video. So to save some time, I've just taken some screenshots of that video. So this is a raw plot of land. This is the starting phase. So now you've seen that there is a rough landscaping that has been done on that raw piece of land. Then you create the zones or subplots. So you can now see the subplots having been made. This is where the utilities are now getting started to get constructed. So this is where you will have an outer boundary wall. You will start developing drainage, sewage, all those kind of things. So these are the stormwater drainage pipes. This is, again, the sidewalks and all getting created. This is the roads getting created. So that's roughly how land development takes place, and only after that entire process gets completed is when the builder will actually have the permission to start constructing the project. So so far there has been no revenue accrued to the builder. Now consider this, that if a plot of land takes 5 years to develop, if annually the builder is selling 100 houses, if the builder wants to keep that run rate up and they also want to grow it, then the amount of inventory that they will need to keep is almost 6 to 7 years of that 100. So you will have almost 5 to 6 to 7 times of your annual land usage as inventory on your books. And again, if you look at the top home builders that are listed and you see their lots that are controlled, I'm using a specific phrase here, controlled, which I'll come to later. But if you look at the lots that they have and the number of units that they sell annually, that's almost 6 to 7 times, which is what I alluded to. Now consider, this is a hypothetical scenario, but a very realistic scenario, wherein consider the unit of economics of such kind of an operation. Let's say the home sale price is about $530,000, right? Let's assume this is all in $1,000. The land for that will be roughly like $100,000. The builder makes a gross profit of 112, which is about a 21% kind of a gross profit margin. You deduct the cost for sales, marketing and all that, and you get to an operating margin of about 12%. So this is how the P&L looks like roughly. What would be there on the balance sheet? As I said, you will need 6 to 7 years of inventory on your balance sheet if you are owning it. So here I've assumed 5 years of inventory, so that is about 500. You will need some inventory for the actual construction that you will do. Some part will be there of the house itself that will be constructed and so on. So which have taken just about 6 months odd. So overall, the capital that is stuck in the inventory is almost $750,000. This turns out to be an inventory turnover of 0.6x. Again, not very unrealistic number, as you will see in the future slides. So considering that, if you look at the return on inventory, right, I have not even considered the other assets that the builder will need to have on the balance sheet. But let's just say the return on inventory comes out to be just about 8.1%. Obviously, you can fund it via cheaper debt and all that, and you can spruce up your return on equity. But this is not really great economics when you think about it. The other problem with this model is, what happens if the land price that you're owning goes down by 20%? You're making an annual profit of something like $61,000. The land on your balance sheet is something like $500,000. What happens if that $500,000 gets marked down by 20%? What does it do to your P&L and your balance sheet? Again, these are not hypothetical scenarios. This is exactly what happened during that cycle. So this is one of the top US home builders. If you see this cycle from 2002 to 2006, you saw operating profit went up materially with the increase in revenues. What you will also see is that margins went up quite a bit. And this is bound to happen because if you own land or if you purchase land for the next 5-6 years, and over that period the land price keeps increasing, then your profit margins over that period will continue to increase because you have land which is purchased at a lower price. So you saw profit margins increasing. Over this period, the builder made about $7 billion of cumulative operating profit. The builder kept on reinvesting that in inventory. So over this period, they bought about $6 billion of additional inventory. The total inventory at the end of the period was something like 9.8 or almost $10 billion. What happened subsequently is that prices of land and houses collapsed. Consequently, you had to take a substantial write down on whatever inventories you had. And over the subsequent 5 years, they took a write down of $6.5 billion. When you think about it, almost the entire operating profit got wiped out in the subsequent crash. This builder fortunately survived because it did not have a lot of debt, but this is where a lot of builders went bankrupt. So when you think of the problems that are there in real estate development, the first problem is that land development is risky. So as I said, you'll do your due diligence, you will try to ensure everything is in place, but you can never be sure that something will not crop up. And I'll elaborate this in the future. The other problem is that you're holding so much of inventory and there is a market price risk on that inventory. To the extent that prices only move up, keep moving up, you're fine. But if the price is correct, then your balance sheet is then in a bad shape. Holding all that inventory is capital intensive. So you need funding for that, as well as we have not even talked about the construction and development piece yet. And finally, every project is different. So a developer might be extremely successful in one geography, but then have trouble in some other geography. And again, I will see an example of in case of an Indian developer itself, but even within the same city, you might have a developer being successful in one area and not being that successful in other areas. So while the presentation is largely from the perspective of US home builders, the problems that Indian home builders face are not very different. So Oberoi has been an extremely successful developer, very reputed developer. Many of their projects are marquee projects. Financially also, they have done reasonably well. In 2005, they bought a plot of land in Mulund from Glaxo. So they did not buy it from anyone, but this was an MNC company that they were buying it from. This is 2005. Subsequent to that, the government of Maharashtra said that that plot of land cannot be used for residential construction because it's a private forest land. In fact, if you look at their DRHP, they clearly mention that in India, property records do not provide a guarantee of title. Property records have not been fully computerized. The process may take a significant amount of time and result in accuracies or errors. Now, Oberoi got listed in 2010, and if you go back and read the transcripts over that first 3-4 year period, and you just read the comments around Mulund, it will tell you, how things can get delayed. So first, the Supreme Court, the government said that, you can't construct here. They went a lot, and this was not just Oberoi. In fact, Godrej had properties there, other builders had properties there. So they went to the court. The Supreme Court said you can start construction provisionally, but go back and get the approvals that you need. So they said fine. I think in 2011 or wherein this Supreme Court thing came, they went back to the state government's Ministry of Environment and said, give us an approval. For a year or so, that approval was pending. Then it got stuck at some other department. So every year the company says that in the next 2 quarters, we are going to begin construction. But it took 2014 for another Supreme Court ruling for them to actually start constructing on this project. Again, they've bought that land in 2005. That land is on their balance sheet since 2005. It took 9 years. And again, this is a very good developer. Many projects extremely successful in the same city, but had these issues. So can real estate development happen in a different way? And I'd never imagined that something like this can happen. So all of this owning land, owning inventory is something that I consider integral to the part of real estate. So here we're talking about NVR, and this company was actually founded in 1980. And the interesting part is that the lessons that the rest of the industry learned in 2008 are the same lessons and the same things this company went through in the previous cycle. So just like 2008 or that period from 2000 to 2010, you had a real estate boom from 1980s. The same thing wherein, land prices went up, boom in housing, and NVR expanded materially. Again, the same way the market went bust in the 90s and NVR went through a period of trouble. In fact, it went bankrupt over that period. It had a huge amount of inventory on its hand. And this left a big impression on the founders and the management of that company. After that bankruptcy, NVR in many ways redefined the way business could be done. One of their key, or this was always there, but they took it to the next level, where one of the key innovations that they did was what are called land lot options. Now, what they did was they said there is a seller who wants to sell a land or a land developer, and then there's a home builder. In this case, let's say the home builder is NVR. So NVR said, we are not going to buy the land, we'll buy an option on that land. So they pay a 5 to 10% premium on the price of land. So let's say if $100,000 is the price of land, they will pay an option fee or a premium to the developer of $10,000. Now what that does is, NVR now has, just like anybody who's buying a call option, NVR now has the right to buy that land when they want at a predetermined price. But at the same time, they can also walk away if they don't want to. And till the time they don't buy it, the balance sheet is free from that asset. So NVR pays about an option fee or a deposit. If they exercise the option, they pay the price for the purchased lots. The developer has to sell them the lot if the option is exercised, as and when it is exercised. So if you look at it, the land developer owns and develops the land. It is the responsibility of the land developer to get all the necessary approvals, do all that infrastructure development, everything that has to be done. When you look at the home builder or NVR in this case, they can walk away from this whenever they want. Their liability is only to the extent of the option fee that they have already paid. Also, this lets them not own the asset till they actually begin construction. So what does the process typically look like for NVR? So they sign a LPA's lot purchase agreement. So they'll sign a lot purchase agreement with the land developer. So as I said, there will be many lots. So typically it will be like 40-50 lots in a given plot of land. On one particular lot, they will create what is called a model home. This is at NVR's cost. Now all their homes are what you might call mass customizable, wherein the buyer can decide, whether you want a 2-floored house, whether you want a single-floored house, do you want certain features or not, do you want what kind of flooring you need and all that, but only within the options that NVR gives you. If NVR tells you that these are the 5 set of tiles you can put in or whatever, then only those 5 are available to you. You cannot say that I want a 6th one. Or if NVR's model layouts have like a 2 BHK, 3 BHK or whatever, it is only those that you can choose. You cannot choose a third option. They also mostly work with subcontractors. So they are not themselves manufacturing. They have, in each region, they will have a subcontractor, and these are on a fixed price basis. So now a customer visits the home, the model home. So they will look at the model home, they will look at various configurations that are there. And if they like a particular configuration, they will also go around the vacant lots to see if there is any lot that is of interest to them based on the location and all. So then if they find a lot attractive, they find a configuration attractive, then they'll make a down payment for that house. They will finalize all the options and they will get the funding or the mortgage. NVR will not do anything till a customer's mortgage is underwritten. So it's not about pre-approval or anything. The mortgage company has to underwrite the mortgage before NVR will start construction. After that, NVR buys the lot as per the option that LPA or agreement that they have done, which is wherein the price of the lot is going to the land developer. And they plan the construction process. This whole period takes roughly around 2 months. Let's say once a customer has agreed to buy a certain property and so on. Then NVR starts and completes the construction. Anybody wants to take a guess how long does this take? Yeah, so 3 months on the outer side typically. If you actually read it, many of the blogs and all, they are actually less than they complete it in less than 3 months. Now just once again think through this, that till the customer has the funding underwritten, they have made the down payment, NVR has not spent anything in terms of its balance sheet, or they have not gotten anything on its balance sheet. Also, when the process, at the time when a customer is buying something, because of being fixed priced with the subcontractors, they are very clear what is the kind of margins they are going to make. They already know the price of the land that they are purchasing for. So just to give you a perspective, so they will give you options like these. The customer can decide what kind of layout that the customer wants. Again, you can only pick and choose from the options that are there. You can't say that I like another house which was constructed so and so, so can you do that? So what I've done is there are many blogs that are there which describe the entire home buying experience. So from one of those blogs, just to give you a perspective of how that happens, in this particular blog, the homeowner went on 13th January 2016 for a pre-construction meeting. This is wherein you select the various available options. So as you can see, they will give you options on flooring, windows, lighting options. Do you want an extra light somewhere in the room? electrical, how many electrical outlets you need. Do you need ceiling fans? No. Do you want to buy appliances or no? Don't want to buy appliances. Again, if you read the blogs and reviews, because they're buying at bulk from the suppliers, their prices on things like appliances and all tend to be very competitive. So people have mentioned that, I could have bought this from a Costco or somewhere, but the prices were very competitive. So rather than doing all that, I just preferred going with them. So this is a plot of land, again, 13 January. On about 15 days after that. So what happens between this phase and the actual construction is wherein the mortgage is getting underwritten. The company has to take builder approvals from the county and so on. On 29 January, the construction actually starts. So this is the foundation getting laid. This is the walls or the foundation getting built up further about 5 days later. 15 days later, the frame of the house is there. It's ready. Then the interior thing starts. So about 7 days later, the interior walls and all are getting put up. 6th March, which is about 1.5 months after the start, the drywalling, so interior walls and all have been constructed. This is the kitchen, 22nd March, almost getting ready. And by 8th March, 8th April, the construction was done. And the customer got the keys in a couple of days after this. So the entire process took roughly around 1.5 to 2 months for this customer. Obviously, so for some, it can take more time. But now think of the problems that we discussed in real estate. So land development is risky. By using lot purchase agreements, that risk is getting transferred on to the land developer. Market price risk on inventory. Again, you are not owning any land inventory. Even the houses, the construction period is about 3 months, right? So the price risk is not that much. Very short construction timelines. Capital gets stuck for inventory and for construction. Again, not a problem here. And every project is different. So while from a location perspective, this does not solve the problem. So you need to go to different locations to build. But from the perspective of a model home or from the perspective of configuration, these are all cookie cutter houses. In fact, if you read the reviews, one of the biggest negative reviews you will come across is that they are cookie cutter houses. They will not let you do a lot of things different. So by having a factory-like kind of a setup, they're avoiding the different configuration problem of real estate. So now with this context, let's see, how other developers have learned from the NVR business model. So just like NVR, a lot of developers have started using lot options. A problem with lot options is that not all land sellers want to do that. Some land sellers say that, I have a plot of land, buy it outright, or, I'll sell it to somebody else. I don't want to give you an option or something. So the entities that have evolved to solve that problem are what are called land banking partners. Now, these are typically financial entities. So it's essentially a private equity or a private credit firm which will fund this entity. This will buy the land from the land seller, and it will then enter into an option as agreement with the developer, with the home builder. Again, the mechanics are very similar to what it happens in lot options. The key difference here is that the land banking partner is purely a financial entity. It has no experience typically in land development and stuff like that. So for that, what happens is the home builder is then taking that development on its own. So what will happen is just the home builder will sign a lot options agreement with the land banking partner, and the land banking partner will also sign a development agreement with the home builder. So the home builder will create all the necessary infrastructures and so on, but the land and everything will remain on the balance sheet of the land banking partner. So this is not as clean and as risk-free as you saw in terms of a pure lot options model, but this is still, the balance sheet is still clear, and also your risk is only to the extent of the uh, option fee that you've paid. The home builder can still walk away from this agreement by only paying that option fee. Other models are also emerging. So as I said, in US there are land developers that are listed, and these land developers, they'll take a raw piece of land, get it to a stage wherein you can start construction and sell it off. So some companies, for example, DR Horton, which is the largest developer, they bought a majority stake in this land developer, and they got into an agreement that a large proportion of your lots, or any lot that you buy, you need to first, I have the first right of refusal. So first show it to me. If I don't like it, then you can go to somebody else. Again, some other interesting things. So Lennar is the second largest home builder. What they have done is, on their balance sheet, they had a lot of land. So they said they spun off that entire land into a new entity, which is called Millrose, which I referenced earlier. This entity now is like a land developer and with lot options given to Lennar. Now, again, in many of these cases, it is not a completely risk-free transaction. The parent entity, or let's say a Lennar or a DR Horton, still have the liability to the extent that the equity is invested into any of these entities. But overall, if you see the amount of this is for the top 11 home builders in the US. The blue section of the bar is how much of the lots they owned on their own balance sheet, and how much of the lots were optioned or were owned through options through other entities. So if you look at 2011, that was almost 75% on balance sheet and 25% through other entities. Today, that number is 27% on the own balance sheet, and 73% is owned through the other through options. For this, not actually owned. That's why I use the term controlled. Again, not all developers have the same or are using this to the same extent. So to the extreme is NVR, which is like, which typically always uses lot options. But again, large developers have substantially pivoted to this model. So if you look at the likes of DR Horton, Lennar, uh, Hovenian, they're all purely or largely using lot options. Again, you have some entities which are much lower on the scale, wherein they're using only 25-30% of the uh, overall lots that they control are through options. Uh, Dream Finders is an interesting company. It is essentially what they replicated they've tried to replicate the NVR model. So this got actually listed post the crisis, but if you look at the presentations and everything, they've tried to emulate what NVR does and try to go fully asset light. So the success of NVR is now, others are starting to learn from it and emulate it. Again, there are some challenges or, drawbacks of this model. The biggest drawback is that eh, as we went, as we started with the land banking thing, not all lot sellers want to enter into an agreement or enter into an options agreement. And if you go to a land banking partner, then you are giving up some of the margin to that land banking partner. Whether you own lot options through the seller or through a land banking partner, that 10% option fee that you are paying is a hit on your margins. So we spoke of how NVR does construction very fast, and that many builders are now doing the same, wherein they're improving or they're trying to shorten the construction timelines. So Pulte is one of the large developers, a top 5 developer or a top 6 developer, and they acquired this company called Innovative Construction Group. And what they do is that, so one way of constructing a house is you do everything on the site, which is called on-stick framing, wherein all the laborers, the lumber, everything goes to the site. On the site, it is constructed, cut. So everything happens from scratch. The other way is what is called prefabricated or modular homes, which is what we saw in case of NVR, wherein the frame was ready in about 10-15 days. Uh, so ICG does that. And what Palte did was that they acquired ICG, I think a year or no, almost I think 5 years back. So this is just a video of how the process works. So this is 6:15 a.m. in the morning. So all these wall panels and all are ready from the factory. Everything is pre-cut, labeled in the factory itself. So these are roof trusses which will support the roof. So the entire thing of this is called framing. So obviously there is more process to it in terms of drywalling and all that happens that, but the framing itself gets done in 3 days. Now this, when if you read the transcript of when this acquisition happened, uh, the key reason that was cited was that in US labor availability is becoming more and more of a challenge with each year. The cost of the labor is increasing. So companies are trying to reduce that labor usage by being as much automated as they can. This saves wastage. So by everything being computer aided and manufactured in a factory, the wastage is lower. It's faster, and there is a lot less indirect costs. So one of the key advantages that is that in addition to the actual labor on site, to manage all that labor, you will need a lot of other staff in the firm itself. So all that staff you don't need if a lot of it is getting done in a factory. The interesting thing is this is not something that is widely used. It is only the top or the large builders that are using this. The smaller builders are typically still doing things the old way. So Builders First Source is a company similar to ICG, but rather this is like the largest building materials company. And in one of their transcripts, they mentioned that in some markets, you can't even get a builder to use pre-cut framing. And the reason is they believe that this dumb downs what they are doing themselves. Like if everything is built in a factory, then what am I there for? So there is that resistance still in a lot of contractors and laborers. Um, if you see the amount of time it takes to construct a single family house, on average in the US, that amount has not gone down. So it is only the large players who are using these kind of techniques. The other thing that is interesting about the US home building industry is that if you read the transcripts and you read management calls, they're very disassociated from the actual price of the house that they're selling. So they don't mind if let's say they've sold a house on a lot and there is a lot next to it, and now if the price has gone down or if the market price has gone down, if there's a correction, it is not that since I've sold the house next door at a certain price, I will only sell this at a same or higher price. If the market price is down, then they're fine doing that to clear the inventory. So it's all about how fast can I rotate my capital. Again, this is, at least in my experience, very different from how Indian developers talk or how Indian developers have behaved in the last cycle. So in the last 4 or 5 years, the real estate cycle has been fairly good. But let's say you went back to 2017 and 2018, and when you spoke to Indian developers and you said that there is so much of inventory lying on your books, why don't you lower the price and clear that inventory? One of the biggest pushbacks was, I have sold 40% of my inventory at this price. Now if I sell the rest at a lower price, my existing customers will feel that we didn't get a good bargain. So in case of US home builders, there is no such thought. If the price is down, then so be it. Again, if you look at the unit economics in this case, right? So we've seen the owning all inventory part, wherein you had a return on inventory of 8%. When you use lot options, so let's say the land price is now 15% higher because of the option, but now your inventory is substantially lower. So in this case, I've still assumed, let's say, a 1.5 years kind of an inventory on the land. If you can improve on construction inventory also, your inventory turns can be 1.5x or so. Again, not a very unreasonable number, as we'll see. And now your return on inventory is very good. So you are sacrificing margins. In this case, you are sacrificing about 3 percentage point to margins, but you are getting a much higher return on capital. No, so I have assumed that you will still own some inventory. So like the likes of NVR in their case, this will be very close to zero. So I am assuming, let's say, you will still own about a year's inventory, which is what many developers still do, as I said. So in that case, if you option it out completely, then your return on inventory will be much higher.
Hi, just one question. I don't know if you are going to cover, but why is the seller willing to take that risk of developing and everything at the same price? Ideally, he would have asked for a higher price if you are taking an option. So what
So you're getting the option premium, right? You're getting that 10%.
10% he would want to delay his cash flow for 5 years, develop the land and everything?
So as I said, in many cases, if they're not doing it, then the private equity partner is giving them the cash upfront, and the private equity partner is then getting that 10%. In many cases, that option fee is then recurring. So just like you will, if you buy a call option, you can keep renewing it. So in many cases, they will, it's more like an annual 8 to 10% cost for the developer. Yeah. So quickly, some other points. The market has consolidated. So if you look at the market share, according to some publicly available databases, about 20, in 2005, 25% of the market share was controlled by publicly listed or large developers. Today, that has gone up to 50%. And this is largely because post the financial crisis, funding and availability for smaller developers has become more of a challenge. Also, they have not been as efficient in moving towards newer techniques like we discussed for the larger developers. Top 10 markets, 2007, or top 50 markets, the top 10 builder share was about 40%. Today, as per the Builder magazine, it is close to about 78%. So markets are getting very consolidated. A result of not having a lot of inventory, not getting the cash flows stuck in inventory, has meant that balance sheets are much better. So if you see the median net debt to EBITDA of home builders, it's very close to debt free today versus being almost 4 5x 10 years back. Return on capital or return on equity has improved. So almost, as I said, from that unit economics, this is like close to 15%. This is again the median. For some companies, it's much better as well. Again, since the cash flows are not getting stuck in buybacks, most of it has been cash flows are not getting stuck in inventory. Most of the debt is repaid. A lot of the cash is now getting repaid in terms of buybacks. If you look at the top home builders, their aggregate buyback is close to about 5% of the aggregate market cap. Just a few slides to make that comparison on. So this is on the left side are all US home builders. Right side is Indian real estate developers. And this is, inventory turns. So let's say inventory this is inverse. So revenue by inventory. Sorry. So if you look at on the left side, the inventory turns for US home builders are much better. They're almost like 1.5 times on average. While in case of Indian real estate developers, in the traditional way of doing things, a lot of the balance sheet is stuck with inventory. So there's almost 5-6 years of sales in inventory. When you look at margins, as I said, if you're owning the inventory and the prices go up, you will make higher margin. So you will notice that in many cases, Indian developers will make a higher operating margin. On the left side is US developers, right side is Indian developers. So you make higher margins if the prices are going up, which is fine. But in terms of return on equity, that higher margin is not compensating for the amount of inventory or amount of capital that is stuck in the inventory. So most US companies today, home builders are at like 15-16% ROEs. Again, depending on how asset light you are, the ROEs can be actually much higher. While in case of Indian companies, that ROE has been much lower. So final slide. As I was studying this industry and doing all this analysis, one book that I kept on going back to, or I was constantly reminded of, was this book called Strategic Logic by J. Carlos Gerillo. This is, in my view, the best book on business strategy that has been written. And so we've been, all of us know Potter's 5 forces, the thing about competitive advantage and barriers to entry. The key insight that is there in the book is that if you look at any company, that company does many different activities. So a mobile manufacturer is designing a phone, is doing R&D. They might be making the mobile. They might be making the software. They would have a finance division, all of that. Now, what this author argues is that even in the most profitable companies, majority of the activities don't contribute to profitability or are not high ROC generating profitability activities. It is only few activities wherein a given company has a competitive advantage. So when you look at something like an Apple, they realize that their competitive advantage is in designing phones, doing R&D and all, not in manufacturing of the phones itself. And which is where they said, we don't want to do this, let somebody else do this and earn that ROE. The other thing is that a company can eliminate many of the things that that is not generating or they don't have a competitive advantage at. They can outsource that and nothing changes because anyways the company does not have a competitive advantage there. Finally, this division of activities is far from evident. So it needs some deep thought. So as I said, for me, real estate development always was the way it is traditionally done. But I think these examples show that a real estate company is essentially two companies. So one which is owning the inventory and which is earning a return on capital on that inventory based on the appreciation in that inventory. And the second part is the actual manufacturing or the home building or designing process. The ROE is actually much better on that second part, which is something that, over time, US home builders have understood. And that is why that first activity is wherein they're not they're slowly trying to outsource it to other entities. So that's it. Thank you. Any questions?
The problem in India, for example, for even if the developer wants to improve his ROE, would be ready reckoners. Because a lot of times, he can't sell below the ready reckoner. I mean, if he wants to have a faster turnover on his inventory. So, question is, in your research, did you find in the US also there is some sort of a minimum benchmark rate or like a ready reckoner rate? Because if that is there, then they cannot, it's not really a free market, that they cannot sell one house at say $1,000 and the other one at $800. They're having a faster turnaround. Did you see something like ready reckoner kind of a thing?
Um, I didn't come across any such thing in the US. I did come across many cases. So, for example, if you read blogs going back to late 2007 or early 2008, people have described how they could get big discounts because the home builder had realized that the market is going down and they need to clear this inventory. So, in many cases, I found that uh, the home buyers did get discounts or they had lower prices. In the calls and all, the developers are openly saying that we don't. So again, right now, if you look at it, the cycle is slowly starting to turn for the worst because interest rates are at a high there and so on. So in some markets, prices are starting to correct. And what developers are saying is, we don't mind uh, if I have to correct the price, I'll correct the price. I'm fine lowering the price. Um, I have not come across a specific regulation on ready reckoner there. Yeah.
So US home building model can work in India. Uh, what if land builder wants to construct a 30-40 floor apartment, because in metro cities like Mumbai or Pune, hardly 1 or 2% people stay in the row house, rest other people stay in the apartment. So is it possible to build 15-20 floor apartment within 1 or 2 year?
Mm, So again, I've heard of constructions getting faster. So I've heard of cases wherein multiple story buildings have been constructed faster, in a couple of years, probably not in 1 year or so. Um, I don't think a lot of that capital or freeing of capital can come from just the construction shortening beyond the point. uh, I think it can more come from the fact if you sell faster or if you're willing to, not stick to prices, or if you can find a partner which can take that inventory from you and you go on to do something else. So not exactly analogous, but when you think of something like REITs, right? So the developer is saying, once it's constructed, once there are, you know, entities, once it's rented out, your risk return then is, the REITs, rental return, and some inflation, which is not commensurate with the return on equity that a developer would want. So they're saying, let somebody else who wants that kind of a risk return own that asset. So to that extent, if you can find entities who will take that inventory from you, uh, that can be one way probably that capital can free up. Yeah. Yeah, good.
Yeah. Hi. When we are comparing the inventory turnover ratios in the US and in India, so how do they do the accounting? Because here we do completed contract method. So the inventory is not just the land. Inventory could be the construction cost that has spent, because the construction will go on for 4 years and whatever amount you have spent is also booked in the inventory till the revenue is recognized. So how do they recognize the revenue?
So, I'm not exactly aware of the accounting standard that is used there. Having said that, the inventory there also consists of land and constructed inventory and in construction inventory and so on.
Yeah, because if they don't do completed contract method, then the comparison would be not.
So, again, this was not meant to be like an apples to apples comparison, but even I think if you adjust it a bit here or there, I think the business model or the numbers are too widely different for that to account for it. So at the end of the day, you can see the material difference in ROE that the two firms are making.
No, actually, where it is poised, yes, the cash flows.
Yeah.
ROIs will not be so materially different because the accounting treatment is very different. So there, the cycle is so short. It's a 3-month, 4-month cycle, whereas we have a 4-year cycle.
Yeah.
So actual ROIs are going to be much higher because you collect the money from the customer, but you don't account for it.
So again, I didn't put it here, but if you look at the ROEs or IRRs on some of the development projects, so many companies will give you the IRRs, or they will not give you the IRRs, but they will give you the cash flows that are spent on individual projects. And if you do that IRR calculation, the IRRs are not very different from what the ROA is telling you. So in fact, I mean, if you talk to sell side analysts in Indian real estate, they'll tell you we never look at it from an IRR perspective because IRRs are going to be low. What we are looking for is an NAV point of view, that over a certain point of time, this is the kind of NAV you are making on this. So at least for I didn't put it here because it might uh, it might have gotten controversial, but I have done the IRR calculation on multiple such projects, and they're not very different from what the ROEs are telling you. Sorry, Rajiv just wanted to. Okay.
Oh, so just for Ninad's point and the person asking question, accounting standards, accounting assumptions result in timing differences. In which year will the profit be recognized? Let us say you bought something for 100 and you sold for 150. 100 is including land, construction cost, everything, and 150 is the final selling price, which you have handed over the keys, you have handed over the possession legal right to the buyer. 50 is your profit, regardless of which accounting standard you use. Once the house is delivered, there's no difference. Here in the Indian case, even after the inventory passes hand, the return ratios have been extremely poor. It's not about choice of accounting or anything like that, because the cycle. So he gave the example, right? Oberoi purchased land in 2005 till 2014. You don't know whether it's forest land or constructible land. When that goes out of the equation, the whole thing changes very dramatically.
So I want to get some more clarity on this land option thing. Uh, you know, so somebody asked this question: why would a land developer spend 100 and wait for 5 years to sell the land at 150, unless it is that 10% is annual cost of option?
Yeah, so it does not. Typically the land is not getting, or the LPA is not agreed for a 5-year kind of a period. It will be agreed much closer. And second, uh, it will be if it is longer. So, for example, if you look at Milrose's presentation, in their agreements, it's an annual option fee that you are paying. So, in their case, that 8 to 10% is then annual every year, not just for.
So basically, the developer or the builder he will take options only on 1 year sales equivalent land, and basically make a forecast and take option only 1 year, for 1 year what it can sell within the year. Otherwise, it will not make sense. For 5 years, 50% is the cost of options. So which means that you are foregoing inventory, and every year you have to buy land, or whether in the form of option or buying actual land, you are making that purchase every year. That decision is made once a year for the next year.
No, so as I said, these are also multi-year. There are multi-years also, wherein every year the company will incur an 8 to 10% cost on that land. So if it is 3 years, then even on year 2 or year 3, the company will have to pay whatever is the agreed amount upon premium with the developer to keep that option continuing.
Yeah, if you take 3-year options and you end up paying 30%, your margins will go down. Either the land price should appreciate, or the home prices should appreciate. Otherwise, you will take a big hit on the margin if you have to pay 10% every year for 3 years. So land is a cyclical business. My suspicion is if you try to book land basically for 1 year, then it will work when the market is not euphoric. It's kind of stable, and there is probably less demand than supply. But the moment it gets supply uh, becomes less, and there's people who control the land, they will jack up their prices. So it's like in India, so if you compare, there is land is not accessible in metros, easily accessible. You can't buy every year and build, right? So the builders, and there is a thing that land prices always go up and home prices always go up. It doesn't work like that, but that's what people believe. The common people, investors, builders, everybody believes that. Analysts also believe that. So people like to hold land for 5 years, etc. It makes sense because if you commit to a project, and if you don't have enough land, you build for 1 year, sell for 1 year, and then you have all the infrastructure and people and fixed costs, and if you don't have land to build for next year, you will be in trouble. So it's kind of a very tricky. If you look at it, let's say the land guy is not interested in holding for the builder and he sells it to private equity. Now, private equity guys want returns of 15 to 20% annualized.
So again, there will be other financial transactions probably involved, like leverage or stuff like that, or the private equity player. So this is not the only thing that the private equity is invested in. Again, to your point that there will be an annual increase, to the extent that there is an increase in the price of land, in that example, there will also be an increase in the price of the house. So I am assuming that on a like to like on the same today's basis. But if you are saying I'm buying rather than buying today, I assume that I'm selling, I'm doing it 3 years down the line, and over that period, the price of land has appreciated by 30%. Then the price of your house would also most have been likely have been appreciated by that amount. So you will not take a hit on the margins. It's not as if the price of the land will go up, but
Let's say there is a nice lot and you took 1 year, you are a great builder and you took option for 1 year, you started building, and the area, that particular location becomes very popular with the builder. So before you complete your first year and you commit for the second year, some big guy comes and takes next 4 years inventory.
no. So your
Fixed costs, your organization, etc., is left high and dry. Something you market it, a new location you market it.
no. So to the extent that you have bought the option, that cannot happen. So there are lawsuits. Actually, if you go and read, there have been lawsuits which have wherein something similar has happened, wherein and the idea of an option is that the seller of the option has the obligation to fulfill that option. So to the extent that that option is still in place, you need to you can't go away from it. And courts have generally sided with this, wherein the home builder, because they're actually paying for that right. So again, this is not something that will happen in all cases. So as I said, if you this is generally happening with the top 5, top 10 builders. A lot of the home construction still might be happening with the usual way. Also, somebody like an NVR, because they are so uh, they are so conservative, or that they don't want any kind of risk. They don't even prefer doing land banking deals. So in their case, the availability or the market size is relatively smaller. So their growth has been relatively lesser versus the other developers. So if you throw the inventory thing out of the book, you can grow very fast. If you say that I'll only pick and choose the projects wherein I'll get options, wherein I'm profitable and which meet all the tech box, then your growth will be to that extent much lower.
So in India, what builders are doing to become more efficient is, they are doing JDAs, for example. They announce it, but
Yeah.
still there is a tendency to hold too much inventory, that people are not focusing on inventory terms. So JDAs are there, or redevelopment projects in Mumbai and all that's happening. But still, I think builders are holding too much inventory, and because of that mentality, and focus is on profit margins rather than the ROI or ROE. So that's the mentality.
Yeah.
Thank you for a nice presentation.
Yeah. So, how effective is this model? Just wanted to understand. This model is effective because their construction turnaround time is very fast, and not actually means what I was able to understand is ki the options on the plots which the US is doing, not that part, but their faster construction turnaround is the mode of this model being so effective there, and the reason for their high ROE numbers is means just wanted to know your view on that. Okay, no, is it faster construction time because any which ways 10% you are saying that option cost will be adding up every year, so that will what you can say put pressure on the margins.
It does, but if you look at from a balance sheet perspective, the inventory that is stuck in land, or if you look at a player which does not have a lot of options, or you look at real estate developers in 2005 or 4, the inventory that is stuck in land is a far bigger component than the inventory that is stuck in construction. So, as I said, the average construction timeline, the average is about 8 months. The faster developers are, let's say, doing it in 3 months. So, to that extent, there is some benefit, but a large chunk of the capital that is freeing is because you are not owning land for that long amount of time. That is where the lead time is almost 4 or 5 years. So, owning a construction, even if it takes 8 months, that won't make too much of a difference, or it will make a difference, but it is not that material versus owning a plot of land for 5 years on your balance sheet.
So, I wanted to make another comment. How Indian developers are different is they are taking money at advances from customers. That is also potentially making them efficient. So I don't know why all these listed companies are not showing good ROEs, but they are, uh, for a 5-year project, 90% of their construction linked uh, customer advances are taken in 2 years' time. So they are that way they are using customers' money to complete the projects. So one key difference I wanted to point out between US and India is that I think if you talk to any builder here, he will say ki it's very difficult to get a good land parcel. Whereas in US there is the cities are big. There is a phenomena called urban sprawl, right?
Yeah.
So I have lived in US, and my colleagues, they said some of them were driving from 50 miles, that is 80 kilometers away, because they didn't want to shift their homes. So for them, 50-mile drive is normal. They don't. And I, in my own rental agreement, there was a condition that unless your job is shifted by more than 50 miles, you can't leave this house. So I was shocked to find that condition. So because of that urban sprawl, there is not really a constraint of land. There is plenty of land. US is, there is too much land in US. So, the builders will not find any constraint in getting good piece of land, but that's not the case in India.
Yeah, land availability is better than India for sure. Yes.
Builders may want to hold big inventory to keep growing, and that's a competitive advantage.
Probably.
Yeah. Do you think technology like 3D printing will revolutionize the process in the near future in the Indian markets?
Indian markets, I don't think so. In US, many of these companies like ICG and all, again, because it is wood and other associated materials, their companies are talking about 3D printing and stuff. But if it is a largely concretized house and stuff like that, I don't think it will make too much of a difference, at least in the near term for Indian markets.
Thank you.
Anyone from the Zoom audience has any questions, please unmute yourselves. Since there are none, we'll end the session. Thank you, Rukun.
Good. Thank you very much. Thank you.
Whenever things got rough, I always remember what my father used to say.
Running a business does test a man, my son. There are ups and downs, glorious highs, and sometimes a low that leaves you feeling defeated.
The character of a man and the character of a business are not very different, are they?
Yes. But when the chips are down, we must stand up, dust ourselves off, and motor on.
Volatility. It's a funny thing. It makes you question yourself and wonder if you've made all the right decisions.
Sure, you can question some of your decisions, but stay steadfast on your goals.
Dad always said, there are no shortcuts and no quick profits.
There are no free lunches, are there? There is only one
right way.
At PPFAS, we think like Rahul and his father. That volatility is a fact of running a business. And buying equity shares is like owning a part of that business. We use value investing principles to manage your money. This means we invest in the right businesses at reasonable prices and for a longer term.
PPFAS Mutual Fund. There's only one right way. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.